Okay, here we go, Sonny. Here is February 25th, the close on February 25th. Here is the open on February 27th. I see the open on February 27th happened at 21:30 GMT time. And then after the open, it fell to right here, which is 0:00 London time, which is this bar right here. 00:00 London time. That open is 1.3733. That's the number we want to keep in mind throughout the rest of the week. Okay, so now there's our weekly open, and we look and see here is the low, and the low is 1.3711, and now we watch it climb. We're watching it climb, and we go forward. We're going forward, and at 10 o'clock London time, which is right here, is 10 o'clock London time, this red bar. This red bar, the open of that red bar is 1.3822. So now we see our high of the day and our low of the day. So our high of the day at that point was 1.38, this bar right here, 1.3832 was the high at that point. The low at that point was this point right here, 1.3711. So we can see on our 10 o'clock bar we are almost at the high of the day, and we can see at 1.3824 versus 1.3811 or 3711, we were already 111 pips above or up into our daily range. So that told us that our daily range was already pretty much maxed out, and we're looking for shorts. So at this point we're looking for our pattern, green bar, red bar, exit on the next red bar. So this is a red bar. It wasn't preceded by a previous green bar, so we know not to enter on that bar. This bar, this one was not a green, so we know not to enter there. Now we have a green bar, green bar, green bar. So here is our first red bar following a green bar. So this is our first bar that we're looking to as our trigger. So here's our green bar, here's our red bar. We're looking to go short at 1 pip below this red bar. So we're looking for a 12 pip stop loss and a 10 pip profit, take profit. So we enter at 1 pip below this low on this bar. So here's our entry with a 12 pip stop loss, which would have been up in here, and we go for a 10 pips. So 10 pips would have been about this range right here. So we would have exited with a winner at 10 pips. So now we go forward in time, and we're looking for that pattern again for our next one. We're looking for a green bar followed by a red bar. So here's a green bar followed by our red. Now we look for the next bar. This bar did not go 1 pip below this bar, so that is a no entry. So now we're looking for the pattern again. So this is a green bar followed by a red bar. So we're looking to go short below this red bar. Well, this bar did not go below that bar, so we did not enter. So now we're looking for the pattern again. So we have a green bar followed by a red bar. So now we're looking to go short again. This bar, this is one of those exceptions that I was telling you about. This bar in particular is more than 15 pips in length. This candle is 1.3847 to 1.3831. So that candle is 16 pips. It is longer than 15 pips, so therefore we do not recognize that signal. So even though this bar went below, we do not recognize it because this candle was too long. And you can see that that rule saved us because we did not get a 10 pip take profit. So now we're looking for that pattern again. So we're looking for a green followed by a red. We have it here. This green did not go below that red, so we did not enter. So now we're looking for another red to come. Here is the next red. Green followed by a red. This candle is not longer than 15 pips, so that is a valid trigger bar, and we go short 1 pip below that on this bar with the 10 pip take profit. So we entered right there. Okay, sorry I'm back after that little pause. So here was our next trade. We caught it 1 pip below that red for a 10 pip gain, so that was a winner. So now we go forward in time to the next one. So here's our green bar followed by a red. That was not one. The green next bar was not 1 pip below. So we go here. We have a green followed by a red 1 pip below. So this trade would have been a stop. We entered at 1 pip below, and it went above 3 pips above this bar, so this would have been a losing trade. Then we look for the pattern again. Green followed by a red 1 pip below. This would have been a losing trade right here. Red 1 pip below would have lost it right here. This bar we would have seen that was more than 15 pips in candle length. So we would not have entered that bar, so we're looking for the next pattern. Green followed by red. Okay, so that bar is a longer than 15 pips in candle length, so we would be looking for the next pattern. Green followed by a red, which is this, so this would have been another losing trade right here. Red, 1 pip below, would have come up here, stopped out. So here we're looking for our next trade. Green followed by red. This did not go 1 pip below, so no entry. Green followed by red. Boom. Here we enter with the 12 pip stop loss with the 10 pip take profit. That would have been a winner. Okay, so then remember where I told you about about trade 4 or 5. I start looking to let it run, and also at about 1700 hours is where we're looking to just let it sit in flatline for the day. So here was our winning trade. Go forward. Green followed by red, not 1 pip below. Green followed by a red. So here was our next one. We would have let that run up to the daily range. And that trade took place at let's see, 16:15 London time, and that pip is 14, or that candle is 14 pips long. So that one would have been on the edge of whether I would have entered it anyway, and it's at the end of the trading day, so I more than likely wouldn't have entered that and just called it a day at that point. Okay, so now we just let the market do what it's going to do. You can see where it pretty much drifted, then it started to come up higher again, and here is the open going into March 1st, from February 28th to March 1st. Here's our open. So then we see what we had done by 10 in the morning at that day. So here was our open, and you can see here was the high going to 10 o'clock. This is the low point. 1.3785 was the low, and at 10 o'clock, let's see, 10 o'clock is this point right here. So our high was right here at 1.3844. So 1.3844 to 1.3785, so that's a 60 pip range, and here was our 10 o'clock open. So we're pretty much in the middle of a weekly range, or excuse me, the middle of our daily range, and our weekly range at that point had been 1.3855, and our weekly low had been 1.3711. Our weekly high had been hit the day before. Let's see, right here was the weekly high that got hit on the 28th when we were trading. So going forward, let's see, we get to the 10 o'clock on March 1st, which is right here. So we looked at our daily range, we're at 60 pips, So it says we're in the middle of our daily range. On our weekly range, it's at 144. So we know we still have 200 pips to go on our weekly range up. So that means we're looking for long trades. So as we're looking for long trades, we could have entered on that trade at 10 o'clock, but I wake up at that time and so I'm still analyzing. It takes me 5 or 10 minutes to analyze, so I would have missed that particular trade. On a long trade, we're looking for a green followed by, or excuse me, a red followed by a green, and then the next green. So here was our next trade. So we're looking for going long. Here's our red, here's our green. So we're looking for 1 pip above this green bar right here to go long. 10 pips. That would not have been 10 pips, so we would have taken a loss on that trade because our stop loss would have been 12 pips below that, so our stop loss would have been right in here. With that being our stop loss, that was a losing trade. We would have exited right here, so now we're looking for a red followed by a green, which was right here. Red followed by a green. With that, we would have entered 1 pip above the green, so we would have entered that, and that would have been a losing trade. Well, now we look for our next red followed by a green, which is this. We would have looked to go long there. That bar did not go over the green bar, so we would not have entered. We're looking for a red followed by a green. This one, this bar did not exceed that bar, so we would not have entered. Red followed by a green, so we would have gone long on this bar, going up 10 pips, or stop loss of 12. We did not hit our take profit, so we would have ended up at a loss. Red followed by a green, so we did not exceed this green bar with this one. So now we would have gone to this red followed by a green. So we would have gone long at this point, 10 pips, and we would have gotten out as a profit. Red followed by a green, we would have gone long here, 10 pips, stop loss at 12 pips, and we would have got out as a loss right in here. Going forward, we would have gone, let's see, where are we? Red followed by a green here, 1 pip above, so we would have taken a loss there. Red followed by a green, we would have taken a 10 pip profit here. Okay, I'm back after another pause. So that's how we're going to trade the March 1st day. So now we've traded until 1700 hours, which is right in here. So we stop and we're done trading for the day. We see that it drops, then pretty much flat lines. Then we're looking, here's midnight March 1st coming into March 2nd, and we watch, we see it fall, and here's the low of that day, and here is 10 in the morning on March 2nd right here. Those numbers are the high of the day at that point had been 38.03, which is making the highs, and the low is 37.62, 1.3762, so we're at 61 pips for the daily range, which means we're in the middle. On the weekly range, at that point we were 1.3855 and 1.3711, so we were at 144. So we're in the middle of the weekly range as well. So that says, but we're above the weekly open, so that says we're looking to go long. So here at 10 o'clock, we're looking to go long, and we catch these trades here going long. There was a trade that would have ended up as a loser. That one we didn't catch. That one would have been a loser. red followed by a green, we would have taken this trade. That trade would have been a loser. Red followed by a green. This bar did not exceed that bar. Red followed by a green with an exceed. So we would have taken this trade for 10 pips. Would have followed, looking for the next pattern. Red followed by a green, 1 pip above. We would have taken that for a profit. Here's the next one. This bar did not exceed this bar, so we would have not taken that trade. And at this point we were at the top of the daily range, so we would have at that point stopped trading. So we stop trading. We come to the next day, which is coming in. Here is midnight, March 2nd, coming into March 3rd, right here. So now we're watching to see what happens at that point. We can see there's a low. Here's the low, here's the high. The low at 10 o'clock had been 1.3832. The high was 1.3875. At 10 o'clock we are right here. March 3rd, the daily range is 43 pips so far. The weekly range is 179 pips so far. The weekly range had been 1.3889 to 1.3711, which is 179. So that means we're still quite a ways below the 337 of an average weekly range. So it says we still have a long ways to go up, and then we're in a 43 pip range so far for the daily range, which means we still have a lot of room to go up, and we are quite a bit above the weekly open. So all that says we're trading longs on this particular day. So we're looking for our long entry, which is a red followed by a green by a longer green. So here's our red followed by a green, longer green for 10 pips. That would have been with a 12 pip stop loss. So here's our entry trigger. Our stop loss would have been right here. Our take profit would have been right here. So we would have gotten out at a profit on this first trade right in here. We're looking for a red followed by a green. Red followed by a green. This bar did not exceed that. Red followed by a green did not exceed. Red followed by a green, so we would have taken this trade right here. Red followed by a green, 1 pip up, so we would have gone long here at 10 pips. We would have exited. Red followed by a green for 10 pips, we would have made a winner. Red followed by a green, we probably would have gotten out at let's see, yes, red followed by a green, so we would have taken that at a loss, and it does not look like we would have hit this big huge bar. Let's see, because we would have entered here on a red followed by a green. This bar exceeded this bar by 1 pip, so we would have not have entered, or we would have entered on that, and we would have been looking for a long, and I'm sure we hit our 12 pip stop loss before it went up. So even though that was a huge 80 pip run up, we would not have caught that trade. At this point up here, our daily range had been hit, so we would have stopped trading for the day. Okay, so we're in our daily range. We would have finished ending our trading for that day. Now we would be going into March 4th. Here is midnight from March 3rd going into March 4th right here. So we keep watching to see what happens at that point until 10 in the morning. You can see we had very little range, 27 pips at 10 in the morning. Let's see, 10 in the morning is right here on this bar, right here. This big green candle, that's 10 in the morning. At that point on our daily range we had 27 pips. On our weekly range we had 265 pips. The high was 1.3975, the low was 1.377. So we were at 265 pips, which says our weekly range is 337, and I start looking for reversals at 270. So that pretty much says that we are looking for reversals this day. So we're looking for shorts coming in on March 4th, because our weekly range had already been established and we only had 27 pips of daily range at that point, so we're looking for shorts. So we're looking for a green followed by a red followed by another red. So let's see, here is our 10 o'clock bar right here. So we're looking for a green followed by a red followed by the next red, so we would have gone short here at a loss. We would not have gone short there. We would have gone short here for 10 pips, would have been with a stop loss of 12. So we would not have hit this at a stop loss, so we would have exited right here. We would have been in that trade for quite a while, about 2 hours, but we would have exited at a gain. Here was a big report that came out. I don't remember, I think it was the unemployment report, so we would have missed all of that. So now we're looking for a short, so it's a green followed by a red, so we would have gone short here, green followed by a red, red here, that would have been a loss, that we would not have entered, that we would have entered at a loss, green followed by a red, that would have been a loss, green followed by a red, we would not have entered, would not have entered. That is longer, that bar is longer than 15 pips. This one we would not have entered. This one we would not have entered because this bar did not exceed this bar. This bar right here is longer than 15 pips, so we would not have entered that. Would not have entered there. And right here at 17:05, I probably would have been done trading for the day. But if we would not have been done trading for the day, we would have entered on this one as a winner. So green followed by a red with an exceeding below, so we would have taken that at a gain, and we would have been done trading for the week. So that's the trades for the week. That's the logic and the reasoning behind them. If you have any other questions, let me know.